9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching The China Show. I'm Yvonne Man with Avril home.
We're counting down to the open of markets in Greater China. Our top stories. Asian stocks higher with Micron's blockbuster outlook reinforcing optimism over AI demand. SK Hynix among the gainers as it prepares to raise close to $30 billion in a U.S. share sale. Alibaba shares drop in the U.S. following allegations that it used thousands of fraudulent accounts to access Anthropic's Claude AI model. And we hear exclusively from Jinko Solar about the Iran war's impact on its Middle East business and plans for expansion in the U.S.
You said it, Avril, it really was those Micron earnings that is helping to fuel this AI chip rally once again and really kind of diffuse some of the concerns in the street about whether this chip rally can continue or not, right? This insatiable demand that they're saying when it comes to hyperscalers as well continues, right? With that blowout forecast, you talk about third quarter was a beat as well. And you say Micron is the new macro in some ways as well. You add that with oil continue to slide. I think it's a good day for Asia today.
Yeah, good day for tech. I mean, the stronghold that you have among these memory players, there are just three big names out there, right, that we really focus on. So on top of Micron, we're watching how SK Hynix and Samsung also fare in trade today. And it is a good day. Now, what the street is telling us is also that these numbers from Micron with $50 billion that it expects to rake in revenue versus what some on the street were expecting, roughly 43. We are seeing how the likes of Citi think that this shows there can be more upside for revenues, but also gross margins. You have the likes of Wedbush saying that, hey, this represents how we're maybe in the early innings when it comes to the memory and the chip trade. We had some signs of perhaps red flags, at least as far as the commentary from Vital Knowledge are concerned. It acknowledged, yes, these numbers are good, but maybe when it comes to capital expenditure, maybe that's where the red flag sort of is, right? Especially when you consider the concern here for the memory trade isn't about demand. It's really about the extent in which it can ramp up manufacturing capacity. And earlier, we heard from some of our guests on the outlook for Micron.
The street is starting to get more comfortable at growth rates for the hyperscalers and the broader CapEx of 40% plus. And what that means is that these companies are going to continue to grow faster for longer than most investors expect. And despite all this skittishness within the market, this is just just a resounding endorsement that we are, in fact, earlier than most believe in the build-out.
I think is the free cash flow and their ability to step up and start a more aggressive buyback was one of the key surprises or takeaway. The other takeaway is consensus for the August quarter was around $25 EPS. Buy side expectation was for 30, and they guided to 31. So they continue to beat and raise and generating a lot of free cash flow. And later this year, when the handcuffs are off, they're going to be more aggressive with the buyback.
So let's take a look at how this is all playing out in markets. I mean, no surprises in terms of the after-hours reaction in the stock of Micron. And this is, of course, a counter that has already risen about 270% so far this year, double-digit pop there. We're also watching Qualcomm, right? Another chip maker, which is, a manufacturer for smartphone chips. But now it wants to expand to data centers. It expects to rake in revenues in the billions on that front next year as well. And that's even said to be making products tailored for China. What is this going to mean? Particularly for TSMC when trading begins. Qualcomm is, of course, a key partner. Take a look at how these Micron numbers are dragging up the Nasdaq futures, dragging up the gauges across Asia, particularly the Kospi. That's the standout there. We have AI also turning into macro, right? So unsurprisingly, perhaps, that the likes of Barclays is upping the GDP growth forecast for Taiwan to 9% from 8.8%. Take a look as well at what is underpinning the rally we're seeing in the South Korea benchmark today. It is coming from the SK Hynix stock as it popped almost 10% earlier. And this is following on its unveiling of that $29 billion US listing plan. So really looking to capitalize on the demand for memory. We're watching other players as well, including Kioxia in Japan, and TSMC also running a bit higher in trade today. Now let's take a look as well at what the setup for China is. A couple of things we're watching on the tech front, including Alibaba now fending off these accusations from Anthropic. But on the macro front, dollar China is sitting above the 6.8 handle, and we also have it at the highest level since about a month ago. So this represents perhaps the unwinding, continuing of the debasement trade as the greenback comes back. We had also China, right? It seems to be tapping the euro debt markets a bit earlier than expected, a bit off season, to the tune of almost 6 billion euros. And a couple of other things we're watching out of the PBOC as well, Yvonne.
Yep, we're watching some lines, right? We heard a little bit from Lu Jiazui about what they're doing when it comes to the short-term sort of liquidity. And so what they're talking about now is they're going to add more of these overnight reverse repo operation instruments. So they're adding the overnight reverse repo types. That's going to start in about 4 days or so June 29th and 30th. And they also talk a little bit more about the move is to better handle short-term liquidity needs. So we've been talking about overall, what does this mean, right? And is this a policy shift in some ways here and how they're looking at it? They're saying the overnight reverse repo to use a fixed rate. So we're still trying to get a bit more clarity of what that means. Is this really kind of moving from the 7-day to the overnight? And certainly, what does that signal when it comes to the use of some of these tools? But certainly, that is one sign of them using more of these sort of tools and maybe aligning a little bit more like the Fed as well. We'll get to that story in just a bit here. Let's bring in Jason Liu, head of APAC Equity and Derivative Strategy at BNP Paribas. So, Micron seems to kind of ease a lot of concerns out there. Do you think that this chip rally still remains intact for now?
Sure. I think when you look at some of the major drivers for the market this year, certainly the chip has been by far the most important driver of that. And what we have learned overnight is actually quite interesting because when you look at a market like Korea, year to date it's rallied a lot, and a lot of that is driven by the chip. And when it comes to earnings, we have seen the rolling 12-month earnings being revised up more than 160%. In fact, the pace is so fast that valuation failed to keep up. We're actually seeing a derating in Korea. I think part of that derating is a question that investors want to understand. Can these companies sustain such a high pace of growth? And so we learned a little bit overnight, especially when the U.S. peer mentioned about somehow that these long-term contract could work. Because previously there's a lot of discussion about we understand the chip market is highly cyclical. So in order to mitigate that, these chip companies are now introducing these strategic partners or long-term contract. And we finally start to hear a little bit about how some of those payments will work. So that may help alleviate some concern about the sustainability of these very rapid growth.
People are starting to blame some of these leverage ETFs. Single stock, how many times ETFs in Korea, that is really amplifying these moves and creating quite a lot of volatility. Would you say this it's partly to blame? And how big of a risk would that be?
Sure. I think if I were to take a step back at why Korea is rallying, we mentioned a little bit earlier about earnings. I still believe that earnings has been and will remain the key driver of the overall market direction. And when it comes to these levered ETF, they were actually a relatively modest scale for the better part of this year. In fact, if you look at January to May, the aggregate AUM was roughly about 5 billion on those two levered ETF listed in Hong Kong. And then once you get into late May, we now have another batch of new levered ETF listed in South Korea.
Yeah.
Then the AUM started to grow. So let's say as of yesterday, we've now seen this aggregate AUM of these levered ETF around $26 billion US. So it's meaningful, but as compared to the market cap of those two companies, they had combined, they have about $2.5 trillion market cap. So I think the scale is still not to the same kind of magnitude. Another thing to keep in mind is that this levered product is not unique to Asia. We have seen a lot of levered product being launched in the U.S. over the years, and I think U.S. has now developed a fairly sophisticated way to analyze the dynamics of these levered product, and I think it's still quite new to South Korea.
Yeah.
And so I think the market is trying to understand that with these lever product and these intraday or day-end rebalancing, how would that work? I think the good news is that when you look at the underlying liquidity of the shares and the single stock futures, for example, those two semiconductor stocks trade anywhere between $8 to $10 billion a day, and their single stock futures, the front-month futures, trade around $15 to $20 billion a day. So if you only look at turnover, there seems to be ample liquidity that can, in theory, accommodate some of those increased activities that you see.
Jason, what are the risks, though, in the meantime, as Asia sort of adjusts to this product, the rebalancing at the end of each day?
I think that's a fair question. So as I mentioned earlier, when it comes to these rebalancing, it's certainly a learning process because these products, these 2x ETF, they have been around for a while on the index level. And the market has some practice on how to understand that dynamics. We've seen that in Hong Kong market, in Korea market, in Taiwan, and in Japan. I think the new phenomenon is more on the single stocks, where now the positioning becomes a little bit more concentrated. And I think the situation in South Korea is more pronounced because those two stocks now represent about 65% of the Kospi 200 index. So if these stocks become too volatile, there is this feedback loop back to the broader market. But as of right now, what we have observed is that the underlying liquidity of the stocks and the single stock futures seems to be liquid enough that in theory they can still accommodate some of the EM flow, the day end flow. But also I think this reaction is not linear. So if the market is moving relatively small, I think it does not necessarily create a lot of concern. But if you have a big move, then perhaps investors will start anticipating some of those day end rebalancing and how it could potentially impact liquidity towards the end of the day.
This is also, I guess, a representation of the retail army in South Korea at the time when maybe foreign investors, I don't know, they rethink things given the run-up we've been having in that market. Talk to us about flows you're seeing in the region as well for South Korea, for Japan, for Taiwan.
Sure. I think indeed this is one of the key topics we have received from our clients. So when you look at the fund flow over the past 4 to 6 weeks, foreign investor has been selling South Korea. And I think one of the key discussion points we had is about reaching the limit in terms of their overweight. I think that is true that a lot of foreign investors have been overweight Korea, and maybe they want to take some profit given how strong the market has been. I think in addition to that, volatility also plays a very important factor. Year to date, Kospi 200 is now have a volatility of 60%. That's almost double its regional peers like Nikkei 225 and the TAIEX index. So when it comes to risk management, a lot of them rely on models like value at risk, where volatility is a big part of the input. So you can get into a scenario when the volatility of the market is so high, it's forcing portfolio manager to de-risk simply to ensure that they do not exceed those value at risk limit.
How do you add the macro? I mean, the risks seem to be fading now that you have oil prices edging closer to $70. Does that lend investors more breathing room and maybe a little bit more space to look at beyond just the tech and maybe look more at rotation now?
Sure. I think there are probably 2 or 3 ways to look at it. First of all, you're right that with the de-escalation in the Middle East, I think that generally speaking, the appetite for risky assets should increase. We've actually seen some kind of increase of general emerging market allocation because previously I think investors view that emerging market may suffer a little bit from the elevated energy costs. I think that is true. But on the flip side, we've also seen a very dramatic shift when it comes to the U.S. interest rate expectation.
Yeah.
Right. You may recall entering the year, we're thinking about how many rate cuts we could see, even though we were the one calling for no rate cut. But then now we are flipping to how many rate hike we can see and how quickly those rate hike will happen. So while we get some relief from the Middle East, I think the market is not fully settled on what's the next step or when the Fed will hike. And I think that will also may have to dampen a little bit about that initial optimism.
Jason, hold that thought. We'll have more from Jason Liu, their head of APAC equity and derivative strategy at BNP Paribas. He's staying with us. And we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. Of course, futures we continue to see are heading up here this morning. This is the China Show. All right, we are seeing what has been a pretty fragile Korea market this week, and we're finally getting a bit of relief here, just given what we heard with this news of SK Hynix jumping on plans, of course, of some sort of U.S. listing here. So we are seeing the shares up some 7% in Seoul, coming off just a little bit from the initial sort of get-go from that news. But Samsung are recovering quite nicely here. We're up close to 5, and the Kospi is now getting ever so close to that 9,000 level once again there. So we're talking a little bit more about this $29 billion U.S. listing that SK Hynix is planning. Let's bring in our Asia equities reporter, Sami Cha, joining us for more. I mean, what do we know at this point about its plans?
Yeah, it was widely expected, but then it came yesterday, and it is a pretty big IPO that we're seeing here. The key here is the liquidity. Now the investors will have access in U.S. hours, so they will see SK Hynix as another way to trade, especially when it comes to arbitrage trading as well. And it's becoming just more liquid. That means that it has a chance to re-rate and also to get a better valuation. You know, SK Hynix now trades at about 7.5 times forward earnings, that compared to around 10 times for Micron. There is that steep discount here, even though Micron itself is also pretty cheap. But so that is something that the investors are trying to resolve. I mean, they think that it could resolve the U.S. listing, and also they would be using this proceeds to go and expand their capacity, and also, you know, to really use that to buy more EUV machines and just really funnel all this interest that is in the memory space.
With this interest in the memory space, we've been seeing, you know, these single stock weekly options of a lot of interest here that is garnered, but South Korea seems to be delaying that. What does this tell us, perhaps, of the jitteriness among regulators or authorities there?
Yeah, that's right. The weekly single stock leverage options were weekly single stock options were supposed to start on the 29th, but then they have decided to delay that. We don't know exactly when that's going to happen. All interest is now in the ETF space, especially when it comes to leverage. And the Korean financial watchdog actually regretted launch of these single stock leverage ETFs in these chip makers in May because of the volatility that it has been attributing, especially because of the rebalancing that happens behind all these dynamics. So we also have a huge CSOP ETF that is tracking the SK Hynix and Samsung in Hong Kong here, and SK Hynix one has become the biggest in the world globally when it comes to AUM. So the leverage ETF space is something that we'll be watching continuously.
All right, Sami, thank you. Sami Cha there, our Asia equities reporter. Just want to recap what we got here when it comes to the fix, the PBOC setting it at 682.09. That is quite weaker than what was expected here, and that does mark, I believe, a fifth straight day that the PBOC has weakened that fix there. So it has reflected a little bit of the dollar strength, of course, we have seen, but there is also a sense that the renminbi is in some ways still stronger, relatively speaking, to its basket of currencies, right? So maybe there's a little bit more of a two-way sort of movement that we're seeing in the currency here right now. 680 that we're seeing when it comes to the dollar here. Still with us is Jason Liu, head of APAC Equity and Derivative Strategy at BNP Paribas. We haven't talked about China yet. How much, I mean, there's such a divergence between how people look at the A-share market and the H. Yeah. Do you see that changing in any way for the rest of the year?
I think that's a great question, right? Because I think the way that we look at it, there are probably three interconnected divergences happening at the moment when it comes to Chinese equity. Yeah. And they're all connected. Yeah. So the first one is this tech, industrial, material outperforming consumer. Yeah. The second is the onshore equity outperforming the Hong Kong listed equity. And even within the onshore equity, we have seen small mid-cap outperforming large cap. And they are all interconnected because that's a reflection of the current K-shaped recovery that we're seeing in China. We have seen retail sales being a little bit soft this year because we've seen the reduction of subsidies. But at the same time, export remain very strong. All the AI demand that we just discussed earlier also remain very, very robust. And with that recovery of PPI, it naturally feeds more into the industrial and the material sectors. And when you look at how the onshore and offshore market is set up, a lot of these tech, hardware, material, and industrial stocks tends to be more abundant in the onshore market. Whereas in the Hong Kong market, in terms of market cap, we're dominated by internet companies that tends to be more associated with the consumer spending. And when it comes to the market cap, again, the large cap are dominated by financials and consumer, whereas the small mid caps are much more tech, hardware, material, industrial. So it created this rather unique situation that for investors who are still bullish on this global theme, they find a lot of interesting sector and stock opportunity, but they don't necessarily being reflected on the index level across the board.
So apart from the index level and investors sifting for opportunities in the back half of the year, what are you expecting also in terms of earnings and how that might inform this divergence we're seeing overall?
Mm-hmm. Yeah, I think that's a great point on earnings, because when we look at the earnings revision so far across all the major indices listed in China onshore and Hong Kong, we have seen a gradual revision on the way up for onshore indices, especially for small mid-cap. But on the flip side, when you look at the technology stocks, especially the Hang Seng Technology Index, it's one of the very few indices in our region that actually have seen downward earnings revision. So I think one of the key things that we're watching out closely is that in the upcoming earnings seasons, do we see some early signs of this anti-evolution playing a positive impact on growth expectation for these companies? And do we see more guidance when it comes to the monetization of AI for these internet platform companies that may be able to help turn that sentiment when it comes to earnings revision?
Among the things we're also watching in the back half of the year are these share sales, right? We just talked to Zhang about SK Hynix, but then we also have Zhipu. I mean, how is that going to shape overall markets?
I would say when it comes to these placement or share sales, certainly a reflection of the overall optimism in the market. Investors are willing to allocate into these companies. I think another one that is worth watching out for is that we know that the memory companies in China is also planning for IPO as well. And as you mentioned earlier at the top of the segment, that the big three continues to dominate the market share, and whether or not these Chinese companies can start getting more financial support through listing to increase the production capacity, I think that is something also investor will be closely watching out for.
Jason, always great to have you. Jason Liu, the head of APAC Equity and Derivative Strategy at BNP Paribas. We're taking a look when it comes to the pre-market. Hang Seng under a little bit of pressure here this morning. We're down about 0.1%. Futures, though, coming off some of the initial moves there. We are getting close to seeing some gains, but we'll see. 680 for dollar China. Plenty more ahead. This is Bloomberg.
All right, we have breaking news crossing the terminal in terms of the Korea Exchange now confirming an earlier Bloomberg scoop about this day of single stock weekly options. And of course, this coming against the backdrop of some jitteriness among regulators, authorities as well. We heard some comments from a top financial watchdog chief earlier in the week as well, you know, that regret in terms of not delaying the launch of some of these leveraged ETF products. So we're seeing more signs coming in from the Korea Exchange, that confirmation of the delay, Yvonne.
Yep, so they're trying to find ways to kind of tame some of the volatility that we've seen around the Korea market here. So certainly this is one of the latest moves when it comes to delaying the launch of these single stock weekly options. We got the open coming up next. This is Bloomberg.
Welcome back. You're watching The China Show. We're counting down to the open of markets. A couple of things to watch aside from Micron reigniting this optimism on the AI trade, particularly for memory makers. We are watching, of course, whether we see that continuation of these Chinese chip stocks and the rally that they had just a day ago, on a day as well where we are watching some of the macro indicators with oil, in check, and the extent in which the Iran war, at least for investors, seems to be in the rear view mirror. What that means for the dollar at the time where the U.S. exceptionalism narrative seems to be coming back as well. Dollar China, of course, has been creeping higher, Yvonne.
Yes, the breakout in the dollar has certainly been one thing to watch, right? As Jason Liu from BNP Paribas mentioned there, yes, oil is back down, but you look at the change in sort of the Fed regime and the market's still pricing in rate hikes towards the end of this year, that certainly is one thing to contend with here as well, that it's not really full on, you could still rotate into, the bond market, for example, or other parts of this market beyond just that AI trade, right? So there's still a bit of caution in some ways, right? The macro risks out there. But then again, we just got lines from the Korea Exchange confirming our reporting about delaying the launch of these single stock weekly options when it comes to some of these big Korean names. Perhaps that could add a little bit more, I guess you say, reassurance to this market here on the back of this recovery that we've seen in Korea already, thanks to those Micron earnings. But China, as you say, still low conviction here this morning compared to the rest of Asia. We're pretty flat when it comes to the CSI 300. Shanghai comp is slightly lower and getting ever so closer to that 4,100 level as well. Shenzhen, even some of the kind of darling stocks are doing okay. Capricorn Tech, CATL are pretty much flat right now. So it continues to be sort of that story where Korea, Taiwan, Japan dominate here. We'll continue to watch, of course, some of the tech dispersion across the A-share market, which BNP Paribas did say there's still a lot of interest from their clients as well when it comes to onshore AI plays here, the hardware side of things. But we're not quite seeing that here today. We talked about dollar China. That's one thing to watch here, right? So it was a fifth straight day that the PBOC weakened that fix. Just given what we've been seeing, the strength of the currency. Yes, the dollar has broken out and has weakened the renminbi, but it's still looking relatively strong against other currencies against the dollar. So that's one thing to watch in particular. HS Tech, we're lower by about a fifth of 1% here. Watching Alibaba very closely. This is according to our scoop that Anthropic is now accusing Alibaba of illicitly assessing its AI models. We are seeing the stock lower by about 1.6% here, but we are seeing most of these mega tech in China is heading lower. Chips, though, there you go. A bit of relief there that you're seeing even from some of the domestic names after what we heard from Micron here. This sort of what they see, the shortages of memory are going to continue at least through 2027. They say they don't see really improvement, according to the CEO, until 2028. Montage Tech is up some 6%. Huahong Semi, as well as SMIC, are more up about 1% or so. Zhipu, interesting lines that came through yesterday there when it came to this fundraising round, right? So said to consider this multi-billion-dollar share sale in Hong Kong. This is after, of course, that 2,000% rally that we've seen. So there you go. More fodder, more things to talk about here when it comes to the fundraising side of things for Zhipu. The stock is up another 7%, Avril.
Yep, AI models, developers, they're doing well in trade today. But also, I think what you highlighted, right, really the divergence as we spoke with Jason Liu about as well when it comes to onshore versus offshore, hardware, software. And that is really being reflected in what you're seeing in this chart, right? Performance so far this year of the Hynix and how it's gained almost 40% versus the Hang Seng Tech that is languishing, that drag you get from the internet names, the concerns on the macro front as well. Given the consumption data that we got also not so long ago, investors really still focusing on the picks and shovels of this AI trade. And that is informing, I think, some of the context that we're seeing or hearing from commentary on the street as well, Yvonne.
Yeah, Bank of America, a great report coming through there from their global research team. They've significantly raised their 2030 global AI capital expenditure forecast to $1.7 trillion, which could create shortages in materials and opportunities for investors out there. For more, let's bring in Matty Zhao, co-head of China Equity Research and head of APAC Basic Materials, Oil and Gas Research. You got a big conference coming up this week. I'm sure you're getting a lot of questions about this number, right, that you've highlighted in terms of the AI CapEx spend. So are you saying that we're still kind of in the early innings of this whole AI cycle then?
Yeah, I think our global team and also our Hong Kong China team are very positive on the AI capex spending. We are expecting global capex to be 5 times in the next 5 years. So from $250 billion to about $1.7 trillion by 2030. In China, we are also expecting that to grow from $90 billion to about $330 by 2030s as well. So capex spending are increasing, and a lot of the materials and also the equipment sides are actually in a big bottlenecks, at least for the next 2
Which
years.
are the biggest ones that you see right now?
I would say quite a few areas, like, for example, the optical fibers, or the PCB materials. Like, we are very positive on the glass fibers, who used to be very oversupplied, but because of the PCB increase in demand, the high-end glass fiber was now in big shortages as well. Similarly to copper foil, yesterday we have one of the major copper foil companies' chairman in our meetings. He was very positive. He was basically seeing these shortages at least until 2030s. And even though a lot of the capacity were ramping up.
Matty, talk to us about how some of these players are pretty much able to set the price. I mean, you know, we just take what prices they set, given what you're expecting as well on this CapEx, that it looks to be, you know, not held back in any way.
Yeah, so to be honest, some areas which are very tight, like, for example, like the copper foil or the glass fiber that I just mentioned, price hikes were very frequent. Like, glass fiber price hike is on a monthly basis, 10 to 15% every month. Actually, this month, the increase was over 50% as well. That is because, like I said, a lot of these sectors used to be traditionally oversupply areas. And then now, because of the PCB, because of the AI capex, a lot of these areas who used to be using in lithium or in telecom now has all been in AI. And so you are seeing this upgrade of capacity from low end to high end, but it takes time. So one side is the emerging, very fast growing demand. On the other side, it's taking a long time to raise your capacity. So the mismatch basically means the upstream is also having an upper hand as well, and price hike is quite obvious in the past few months.
Matty, it's interesting also because this week we've had the World Economic Forum underway in Thailand, and some of the signals from the Premier, you know, sounding very positive on innovation in China, along with, you know, support potentially for the supply chain. What are you expecting perhaps on the policy front that can kind of drive things along?
Yeah, so I would say that we expect China capex to grow from $90 billion US this year to $330 billion by 2030. And then from a policy perspective, we recently see government talking about 2 trillion RMB to be invested into the AI areas as well. I think this will be probably through the telecom company, through the internet company, and also through a lot of the government funding as well.
What about the power needs? Do you think the market's still underestimating the power needs that we need when it comes to some of these AI data centers? How do you model that sort of demand?
Sure. If you look at like NVIDIA's models from 2022 through the potential 2028 models, we expect that the density to increase 100 times. So that means you basically need a lot more power to support that as well. So from a power perspective, we are expecting power demand at least to triple in the next 5 years as well. Similarly, in China, we also need to build a lot of the power equipment together with the global as well. So we are also seeing various new trends on the power, including like transformer, gas turbine, ESS power storage, etc.
I mean, most people think ESS, they think CATL, but how would I make a portfolio around these sort of themes now?
Yeah, so for ESS upstream, of course, you have lithium. Midstream, you have CATL and some of the other battery names as well. And downstream, probably like Sungrow, Tesla. These are the major, the ESS producers. And ESS order has been very, very strong year to date as well.
You alluded to some of this earlier about the build-out in China. In terms of the data center building, what is the downstream impact, perhaps, on construction, on industrial growth as well?
Yeah, so we are actually seeing a lot of the construction and industrial growth that are very lean towards the AI growth. For example, the grid investments. We are actually seeing this 5 years government policies, grid investment, compared to the previous 5 years plan to grow by 40%. And this year we are expecting grid investment to grow by double digit as well. So that benefiting a lot of the grid players. At the same time, China is also trying to export a lot of our equipment on the power side, like for example, transformer, gas turbine related.
All right. We're going to have more from Matty Zhao, the co-head of China Equity Research and head of APAC Basic Materials, Oil and Gas Research at BofA Global Research. And just in time, right? We take a look at what we're seeing when it comes to oil markets here this morning. Brent, it has now erased its wartime gains here. So after we've seen flows through the Strait of Hormuz start to reopen here, there is now this narrative in the market that we're going to be seeing a swelling of supplies from the Middle East and all the way from Africa as well. So certainly that's one thing to watch very closely here. I'm watching oil markets very closely. We did briefly drop below that 73 handle when it comes to Brent. There you go. And then when you take a look at some of the sort of indicators, right? You take a look at when it comes to physical barrels, the price of that has been lower. Brent's prompt spread also flipping to a contango sort of structure as well. WTI is already near or close or at as these sort of pre-war prices. So there you go. We're back below 70 when it comes to WTI. Avril.
Yeah, there's even this talk about maybe the market's become awash with too much supply, right? What a difference a couple of weeks can make. But we also have, among the things that central banks are watching, data out of Australia when it comes to employment. Note that these numbers are highly volatile, but for the main numbers, you're seeing that rising over 40,000 on the on-month figure. So that's a beat versus the estimate. And this data is coming along with what we're seeing on the jobless rate, that having declined. So overall seems to be validating the RBA's assessment that the labor market remains tight. And also in a week where we did see the core inflation or the trend mean coming in a bit hotter than expected. We'll continue tracking some of the market reaction as well, given what we're seeing in oil prices. This is Bloomberg. Let's track how Brent is doing. We are seeing now the front-end contract erasing all of its wartime gains, and this is against the backdrop of flows having returned through the Strait of Hormuz amid the progress on the US and Iran peace deal. We're also tracking some of these oil counters, energy counters in China moving along with Brent prices, Yvonne.
Yeah, Matty Zhao, BofA Global Research is with us. Perfect timing, really. I know you guys just lowered your forecast for Brent just a few days ago, but tell us a little bit more about how quickly do you think flows can actually normalize in the Strait of Hormuz now?
Yeah, so yes, we lower our Brent oil forecasts to about $70 for second half and also next year as well. We are still expecting a small deficit for the Q3 because of still takes time for the flow to normalize and then also for the volume to arrive in Asia as well. However, into next year, we believe it will turn into surplus again once this flow come in. One of the key reasons, of course, is the demand is quite weak. As well. If you look at last month's China data, actually import was down 30% on oil perspective. Some of them is because of using strategic reserves or commercial reserve, but I think also we are expecting that the demand was probably down around 10%. I mean, the real demands just on that 1 month perspective. Some demand may be able to come back, like for example, some chemical demands, but some demand was actually permanently replaced by using more electric truck or EVs and also turning to coal chemical, etc.
So you're saying some of it is structural.
Yeah.
Some of it could be cyclical. What else are we watching out for to make sure that, I mean, it seems that we could be getting more supply in the Middle East, from Africa. I think I had a guest yesterday say Venezuela could start ramping up production. Are we... is the market going to be swelling with supply next year?
I think next year, yes. That's what we are expecting. Next year, it will be a surplus. However, for the rest of this year, I think market don't need to panic that much first because at the end of the day, we have already run down inventory for more than 3 months, right? So a lot of the areas will need to increase inventory as well. And then for some country who might even want to have more inventory than the previous pre-war level because of the energy security sides. Yeah. So, but I think the bigger concern is still more on the demand, on like the permanent demand damage.
You talked about how some of that demand might not be coming back for China, though some maybe might be creeping back. If you were to talk about the proportion, in terms of which sectors and how that affects the numbers, if you hazard a guess, what do those numbers look like?
Yeah, so like I said, China's import was down around 30% last month. So imports account for about 80% of China's supplies as well. So just on looking at that, it means that apparent demand is down 24%. But we think that is too high. It's probably because China has been running down some commercial reserve as well. Per our bottom-up analysis, probably the demand was down around 10% because of the high prices. So with the oil prices coming back, we think some of the demand will be coming back, like the oil chemicals, or like some of the using diesels as well. I would say probably 3 or 4% is a structural side, while 6 or 7% it probably can come back with this oil availability and lower oil prices as well. But 3% is actually quite a lot in these oil markets.
Gold, I have to ask you.
Yep.
We briefly dipped below 4,000 right now. I mean, is this rally, this bull market that we're seeing in gold, do you think it's over, given the fact that there are a lot of concerns about the strengthening dollar now?
I think compared to like other metals like aluminum and copper, gold, in our view, it's more of a belief, right? And then also, compared to copper, you don't have that much actual needs, like building the grids, like the ESS, etc. Gold is more like whether the rate hike, strong US dollar, etc. So in the near term, I think clients are quite concerned on gold as well. Also, another thing that will impact is central bank buying. Yeah. We started to see China's central bank buying in a gradual phases. So it really depends on at what level maybe Chinese central bank or some other central bank will come up to buy. Otherwise, from a dollar, from a yield, from a rate cut perspective, probably is losing the momentum to upsides.
Matty, can I ask you as well, what sort of assumptions you might be making on the yuan for the back half of the year and how that informs commodity prices overall?
Yeah, so I would say that our house view is actually US to have a 75 bips rate hike for the next 12 months. And then we are also expecting US dollar quite strong as well. So as a whole, it wouldn't benefit overall metals, apart from but of course, some of the metal may stand out from a supply-demand perspective. Like I said, copper probably will stand out from a supply-demand because of very tight supply. And then also, we are still having some very good support on the demand, like the grid building, the AI building as well.
Talk to us as well about what the leadership of Kevin Walsh is going to mean for overall, this talk in the markets about the unwinding of the debasement trade. I mean, a lot of the assumptions that we made in the first half or coming into this year, they've been turned on their heads.
Yeah, so I think now the market is pretty concerned on that as well. But of course, now with this oil price easing, probably the inflation risk is easing as well. So I think if these oil prices continue to trend or as what we forecast at $70, I think the inflation risk will kind of ease the market concern on the stronger US dollar and the rate hikes as well. But of course, the Fed situation is also one of the market concerns that will have overhang on the commodity prices.
Matty, thank you. Matty Zhao there, co-head of China Equity Research and head of APAC Basic Materials, Oil and Gas Research at BofA Global Research. Still to come, digital investment platform Syfe is going to tell us why they are prioritizing automation and the adoption of AI-assisted tools. The founder and CEO is going to be joining us a little bit later on. Much more ahead on The China Show.
Right, we're talking tech still, and a former president of Chinese tech giant Baidu says he's confident China's AI players can convert massive infrastructure spending into real returns. Tsinghua University's Ya-Qin Zhang also told us how the shift to agentic AI will drive most token generation to so-called edge devices, such as cars, robots, and wearables.
Certainly we're moving from generative AI to agentic AI. And also, the whole token generation going to take place mostly in the future on the edge, on your devices, on the cars, on the robots, on the glasses, on your watches. I would expect in the future 80% of the tokens will be generated not from the hyperscalers, not from data center, but from the edges. So we see a huge revolution and transformation in how we manage and how we interact with devices. What I call the cognitive UI.
Can you separate the hype from the reality in things like Zhipu, their latest model, GLM 5.2, is supposed to be, the expertise is in coding for agentic AI. They're talking about being sooner than anticipated on par with what Anthropic is doing and the like. But again, they're bleeding money, as a lot of these players are. So where do you separate the hype from reality?
Well, Zhipu is a great example of the China innovation in terms of very high efficiency and just like DeepSeek and flexible architecture and with the generate token which are as powerful as some of the frontier models. But right now AI is still in the infrastructure is still in the investment stage. In the next couple of years, it has to prove it's able to generate the real income. That is able to scale to other part of the economy. Obviously, that is a challenge, but I'm confident eventually we be able to prove this investment in infrastructure makes sense.
Tsinghua University Chair Professor Ya-Qin Zhang speaking with our Chief North Asia correspondent Stephen Engel. Now, as we track these memory players, one stock that's standing out as well today, part of the tailwind for memory, Kioxia, and we're also since hearing from some of its executives how it's studying a stock split to make shares more accessible. You're watching The China Show. We'll continue tracking market moves. This is Bloomberg.
Welcome back to the China Show. A look at the CSI 300 a half hour into the session. It looks like the skies are clear in Shanghai here today. It looks like that's the case when it comes to this equity market as well. CSI 300 is punching higher by about 0.8%. And there you go. You continue to see this two-track economy, two-track market, right? Look at MSCI China. We are seeing declines of more than 1%. Shenzhen, though, still looking pretty strong. We're up 1.4 here this morning, Avril.
Yeah, we're seeing these Chinese chip stocks rallying as well on a good day overall when it comes to some of these makers of the picks and shovels of the AI trade. You look at how the Kospi is pulling ahead. It's extending, piling on those gains from earlier on in the session, now 5% higher. And Taiwan also not to be left behind. We have, of course, in the spotlight, the likes of TSMC following on from what we heard from Qualcomm, right? Now it wants to expand to chips for data centers. Could rake in billions in revenues next year. I guess one of the signs of concern is coming from regulators, right? Korea Exchange and how it's been announcing this delay of single stock weekly options, given these wild swings we've been seeing in the markets that have been amplified by the products that are available in the market. Take a look at how some of these chip stocks are faring. And we are, 2 hours into the session, and SK Hynix is, unstoppable, let's just say. Following on as well from the news we got that it's seeking that U.S. listing to really capitalize on things, $29 billion. That is what really got investors' attention, the amount that is looking to raise. China chip stocks, SMIC, as I said, they're doing well. Take a look at what we're seeing on the macro front. Dollar China keeps creeping higher. We did get some of these lines from the PBOC on these overnight reverse repo tools, which we'll talk with our analysts analysts in just a bit, but continuing to see some of these currencies on the back foot, given the resurgence in the greenback. Take a look at treasuries as well. It's been interesting, right? The reversal of the very popular steepener trade that we've been seeing, following on from Kevin Walsh, of course, taking the helm. The 2-year holding flat at 4.14 for the moment, but this is coming despite what we're seeing in oil prices, that continued slide there towards the 70 handle. And of course, we saw in the Asia session, Brent pretty much erasing all the gains that we've seen in this period of the war. Yvonne?
Yep, certainly that is a sign of maybe that risk assets can continue here today, right? You talked about the Micron earnings and the forecast there, which was quite a blowout number there. Certainly is helping to fuel the tech trade here today amid some of these worries about where we are when it comes to this chip rally. The dollar is also breaking out and rallying sharply through. So that does still put some pressure when it comes to risk assets as well. Let's bring in our markets reporter, Anthony Stevens, on really how you're looking at things. I mean, obviously, Micron was a good sort of relief for a lot of us that are watching the chip rally, but can it spread beyond just the memory chips?
Yeah, so the 85% odd margins that they're looking for into the fourth quarter, that is a shortage level margin, right? So that's feeding into the broader chip ecosystem here. You're seeing Taiwan, all of the server plays are very strong. In Korea, obviously memory is strong. That is a pretty much 1-to-1 delta with Micron. So it's no surprise Hynix is trading really well. Samsung is trading really well. But for Hynix, what is very interesting is, they went out and raised $29 billion and the stock's up 10%. That is so rare that it bears repeating. They raised $29 billion and the stock is up. And that is because they're using that money to fund an expansion at margins that are in the 70 to 80% range. So it's an absolute spigot of cash flow. Yeah. And that is feeding now into the Japanese sector. You're seeing the Japanese market being very strong. And that's because the Japanese have a huge chokehold on the chip materials, chip testing, chip packaging parts of the semi ecosystem. So if there is a shortage, these people have kind of order books that stretch into the years. So today we're seeing a kind of a data point for Micron and Qualcomm as they expand into data centers, data points that show that this is a multi-year structural bull market, and that's the reassurance markets have been looking for weeks of this volatility.
Yeah, I was talking to Shuli, right? We were joking in the makeup room about these margins of Micron, 86%. They're bigger than even Hermes's margins.
It's bigger than
right?
J.K. Rowling's margins.
Oh, yeah. Yeah, let's talk about the dollar, though. It seems like it's about to break out in a big way here. How are we set up before the PCE date?
Right, I think so. PCE and Micron actually tie in together quite nicely, right? Is how much of this AI boom is going to come into U.S. economic growth and inflation that is aside from transitory shocks from commodities. And that has been Wash's entire narrative, right? I want to see inflation that is from growth, that is from wages, that is from construction, and not this transitory stuff from energy or food prices. And if we do see that coming through in PCE, and PCE has been trending higher, that can leg the dollar into a proper breakout of like a multi-year range. It's already jumping the gun in terms of like short dollar risk assets like Bitcoin, gold, silver. Those are a lot more vulnerable. Europe broke earlier, 1.14. So there's a lot on docket today with the PCE.
What about oil? We're seeing the continued slide.
Well, oil is, one of these dollar assets that will get hurt if the dollar continues to rally. But in this case, there's also the fundamental driver of the glut of Gulf oil coming on the market. And you're starting to see a lot of regional benchmarks in the oil market in the Gulf going to contango. Now Brent has followed. And what is really going to be interesting is where the oil volatility also follows. The more oil volatility falls, the less relevant it becomes to risk assets. And we can slowly start to take oil off the table as a material mover and concentrate fully on the AI trade.
All right, Anthony, thank you. Anthony Stevens there, our Bloomberg Markets reporter. Back to one of our top stories now. The PBOC is introducing an overnight tenor into its open market operations on June 29th and 30th, a key step to reshaping how it steers short-term borrowing costs. Joining us now is Becky Liu, head of Greater China Strategy and Asia Rates at Standard Chartered Bank. Yeah, she could teach a class about this, really, Becky. Every time we get you on, it's such a good discussion. Walk us through the moves that we've seen, right? We started to hear a little bit more about more focus on the overnight repo rate and the like. Is this just how close are we making the overnight rate into something of a main benchmark policy rate?
this will remain to be a journey. So if we look at the latest announcement of the new FEMA facility, the new temporary overnight repo facility, both of these facilities are still taking the 7-day repo as the benchmark. But clearly the policymakers would want to focus a lot more on the overnight rate so that they have more effective control on short-term interest rates and liquidity conditions. So we believe that over time, the overnight repo will become more and more important, but it's not going to be an immediate change. What we would like to focus on from here would be first, of course, is the rate, the interest rate they will operate next week, and second, how frequently these overnight open market operation will be conducted. Would that be a regular operation, like can be done on a daily basis, or it will only happen during time of tighter liquidity conditions such as quarter end?
The 7-day reverse repo rate is now at 1.4. What are you expecting in terms of this overnight rate? And what could it tell us about signals from the PBOC?
Sure. If we are seeing a neutral situation, i.e. a no rate cut situation, 1.3% would be about right, because the gap between the 7-day and the overnight was about 15 basis points for the last 12 months, but narrower, closer to like 8 to 9 basis points year to date. The average overnight repo in the last 12 months was also around 130. So if we have overnight OMO at 130 and 14-day at 140, that would be a neutral signal. But if we do have an overnight rate at 125 or lower, we see that as a de facto rate cut.
Becky, some of the recent changes or the signals of changes, market participants say maybe geared towards plumbing, towards liquidity. When it comes to the PBOC and the shift towards what the developed market central banks are doing, what is left in there that they need to do?
From the PBOC's perspective, we almost see no chance for them to tighten in the foreseeable future. When we look at China's domestic fundamental factors, the organic inflation remains to be very low. The bulk of the inflation comes from higher energy prices, which would, in our view, would be one, transitory, and second, the bulk of those will become export of inflation rather than a revival of domestic inflation. And on the other hand, when we look at China's domestic credit growth, it's one way heading down. So if you look at household new loan growth, it's turning to the negative territory. Outstanding mortgage loans is outright declining. So from all these factors combined together, we don't really see a chance that China should be tightening monetary policy anytime soon. If anything, they should even slightly lower the cost of funding from both the bank's liability cost point of view as well as from loan rates point of view. So another thing to watch out for, in our view, during this policy rate transition is that whether they're going to change the pricing mechanism of the loan prime rate, i.e. the LPR. Currently, 1-year LPR is at 3%, 5-year LPR is at 3.5%. Both of these are very high level compared with the actual cost of lending in the banking sector. So we don't rule out the possibility that the LPR pricing mechanism will also be changed to tie more closely with the overnight repo rate or the overnight rate, which would also, again, a de facto rate cut from here.
And going on in the background also is the push from China on the internationalization of the renminbi. I wonder what might the streamlining of the interest rate mechanism actually mean for that endeavor?
The streamlining of the interest rate system would mean that China is gradually moving into a more mature system where the central bank would have greater control and more effectively managing the overnight rate. So the overall framework will lead to a decline of short-term volatility or volatility of short-term interest rates in the domestic market and making the funding of the CNY rates more stable. So on the broader context of the RMB internationalization, we see them introducing a number of other measures, including, for example, repo facilities for foreign investors and also the latest FEMA, which is effectively having the PBOC becoming the lender of last resort for many of the central banks that are holding CGBs or other Chinese bonds on their as part of their FX reserves. So a more stable situation when it comes to liquidity definitely support the willingness and incentive for foreign reserve managers to be holding Chinese onshore assets.
The renminbi, I mean, I think it's been in a long window of appreciation. We started to see the PBOC weaken, the fix last couple of sessions here. Do you think there's signs that the appreciation could slow from here on forward?
Indeed, we believe that the pace of appreciation will quite likely to slightly slow down from here. So far this year, for the most of the time, the CNY's pace of appreciation has exceeded the pace of the forward curve.
Yeah.
And over the last few sessions, it's underperforming. But the backdrop is that dollar has been rallying. So under the broader context, CNY remains to be quite resilient. But the thing is that we are indeed starting to see a further widening of interest rate differential. We are talking about 300 basis points of rate differential between short-term CGB and U.S. Treasury rates, 250 on the back end.
Yeah.
And then this trend might even widen further because we, as we said, we see room for China short-term rates to decline from here, and market is pricing in high probability for the Fed to hike. So from the CNY's perspective, how we see is that we don't think this is going to be the end of its appreciation. It will continue to appreciate, but probably quite similar to the pace of what the forward curve is pricing in, and a pace that's slightly slower than what we have seen so far this year.
Becky, the thing about the yuan appreciation also that market participants have been highlighting is how it seems a bit distracted or moving away from the fundamentals. I mean, you look at what is happening macro, consumption, retail sales, that is continuing to be a concern even at a time when they're trying to rebalance the economy, right? How long do you think that dynamic can continue, to your point about, maybe the climb slows a bit further?
If we purely look at economic fundamentals or momentums, it has indeed started to slow down since April this year. But if we look at other currency fundamentals, it's actually staying very strong. For example, balance of payment situation, trade surplus still near record high. And if we look at China's export momentum, it's rising again. And once you dig into the details, you also find that all these export strength, it's still very much structural, either due to a strong demand for new energy products or industrial upgrades, or China is also benefited from this AI cycle across semiconductor exports as well as other related hardware exports. So from our perspective, if we purely look at currency fundamental from balance of payments perspective, it's staying very strong. The only thing that's less favorable would be interest rates. The rate gap between the CNY and the rest of the world has been widening, and our belief is that it will quite likely to widen further from here because we are still talking about monetary policy divergence. But when we look at the broader context of the things, foreign ownership in China domestic assets, it's still very near record low. We only started to see 1 month of foreign funds returning to China's bond market in May after 12 months of consecutive outflows. And foreign holding of all the other assets remains to be very, very much underweight. So there's nothing to be sold by foreign investors at this stage. And from the Chinese corporates' perspective, if they still continue to see hefty trade surplus, the odds is that CNY will stay very much supported despite lower interest rates.
Yep, Becky, thank you. Becky Liu there joining us there, head of Greater China Strategy and Asia Rates at Stanchart Bank. We're taking a look when it comes to Alibaba here. The shares continue to see a lot of pressure, and I think we're around the session lows for the stock here right now. So we're down about more than 4%. This is about on the back of our scoop of Anthropic accusing Alibaba of waging a large-scale effort to illicitly access its cloud AI model. So they're talking about using thousands of fraudulent accounts that could undermine, of course, the U.S. AI developers' decision to keep its products out of China. We're going to talk a bit more with Bloomberg Intelligence's Rob Lee about the impact this could have on some of the other sort of AI players in China and their expansion plans as well. Avril.
Yep, we'll talk about that. And also after the break, we speak to the CEO of digital investment platform Syfe about the company's fundraising and expansion plans. Dhruv Arora joins us next. This is Bloomberg.
All right, we are looking at, of course, what's been going on in Korea here. This rebound is underway. Plenty of news when it comes to the Micron earnings. And then you have the news of SK Hynix planning this U.S. listing is enough for those tech bulls to continue here today and really buy on the dips that we've been seeing this week. So SK Hynix, there you go. We're up close to 9.5%. This is the CSOP SK Hynix daily 2x leverage ETF. That is also surging here this morning. So certainly we've been talking about these single stock ETF moves that we've seen that has really been amplifying a lot of the volatility out there. We did hear from the Korean Exchange this morning about they were going to be delaying the launch of these single stock weekly options as well as a way to maybe tame some of the volatility out there. Let's get more on really what the retail sentiment is at the moment. Dhruv Arora, founder and CEO at Syfe. It's a Singapore-based wealth management platform with more than $10 billion in assets under management, having also expanded to Hong Kong and Australia. Dhruv, it's great to have you back in your former home of Hong Kong as well.
Thank you.
But there's so much going on when it comes to the retail market here right now, whether it's leveraged ETFs and really kind of buying in on this AI trade in North Asia. What are flows telling you now?
Yeah, I mean, we've always believed that retail is a force to reckon with. And if anything, the movements of the last year or two have actually shown that, right? Of course, last year, the key theme around AI, around tech, now we are seeing like 7709. It's consistently one of the top 5 ETFs that we are seeing in Hong Kong. So definitely, they are obviously a lot more indexed on AI and tech. The only little caveat that I bring is that it's bringing some sort of concentration risks, which we can talk more about. But definitely, the activity is at all-time highs, quarter on quarter, new trading records on our sides. And yeah, they're here to stay.
Tell us a bit about the concentration risk that you're seeing.
So if you think about it, right, like, take Kospi, right? You've got like roughly 40-45% on the index now in a couple of names. Take Taiwan, you've got 40% in one name. US also is like, 10 names at like 40-odd%. So the thing was, people always thought, hey, let me track the index because that is passive, long-term, diversified, investing. And the question is it really diversified? And I think that's something that, we have been talking a little bit more about. And we are seeing customers also, to some extent, act on it. Not everyone, because, hey, it's doing well and it's where the direction is. But a simple checkpoint is our non-US trading activity is up 2x, right, as a percentage weightage. But of course, the key driver does remain in the US markets and, of course, some of these leverage names, as you're seeing.
Dhruv, given the volatility in the markets also, we've been seeing this pickup in active investing and what seems like an explosion in trading. Is that impacting the business growth?
Yeah, it is. And I would say it is positively, right? I mean, going back on that whole aspect of the concentration risk, I think what we are seeing is that just the classic, let's buy an SPY or just BYVO, that alone doesn't do it, right? And we actually launched one of our active, products, right, which was in partnership with JP Morgan. And if you saw the performance in the last few months, it has outperformed by 3 or 4% because people do realize that, hey, an element of this activeness is actually required. So yeah, the short answer is definitely. And I think what's really interesting is because the retail has been through few waves, we're talking about the waves that happened in 21, 22, the ups and downs. I think they're a lot more savvy than before, but still, of course, the Elon factor remains strong in some cases, and that doesn't change, right? So
the active ETF strategy with JP Morgan is interesting. What does it tell you about Syfe's product pipeline? Are you pivoting more towards some of these actively managed sort of offerings now?
Yeah, I think our goal has always been around what we say the 3 A's, right? Like access, advice, affordability, right? So I think as people were seeing this concentration risk, there was a demand, could I actually have a bit more of a managed component? So the way how I see it is that we will predominantly still see passive investing. The diversification needs to be better, absolutely. But components of it will start going into active, especially in times like this, right? Because if you're talking these major markets in the world, essentially run by a few names, you don't know what you're really buying into. You saw recently with the IPO inclusion, right? What you bought into might not be what you're still into in some ways.
Right.
Yeah.
Right.
Yeah. Dhruv, can you talk to us as well about what fees are like? What are you expecting in terms of revenues and what are the chances of growing margins? What's the outlook there?
Yeah, you mean for us as a business? So I would say that for us, like, so the good thing is that because we've been a very tech-enabled platform, always kind of build our tech predominantly in-house, our gross margins are actually in mid-90s. And that would remain. And in fact, if anything, it further accelerates. Furthermore, recently, as we acquired an ASX-listed platform, Self-Wealth in Australia, that also now allows us to bring in, synergies. So quarter on quarter for the last, I would say now almost 6 quarters running, we have been hitting like, new highs. And I think as the retail interest keeps on increasing and retail becomes, a lot more, I guess, involved. And this trend that we are seeing, saving to investing, right, which is obviously a key theme we talk a lot about in markets such as Australia, such as, Singapore, and even to some extent in Hong Kong, we only further see that trend accelerating over time.
Yeah, we're seeing sort of the wealth management market it's diverging to two camps, right? Very AI driven, technologically driven, and then there's the traditional face-to-face sort of wealth management. Where do you sit? Where does Syfe sit? And how do you compete with some of these major banks out there that are offering more digital wealth options?
No, absolutely. And I think you make a very good point around what really AI means. And I actually think we obviously were a digital first and remain digital, but we are skewing to AI a lot more than maybe some of these other platforms because we can, right? About 87% of all our code written is now written using AI. And the kind of features that we are launching now for our customers, which were just not available. A simple example is today, and it's live in beta now, you can go and have a search where you can say, give me S&P minus Elon. And it'll give you a basket of stocks. Now, these are the kind of things, when I was a trader back at UBS, we would offer to people like, for hundreds of millions of dollars and pretty lumpy fees. So somebody now with $1,000, $2,000 can get this, even though I think the searches are more like S&P Elon plus. But the premise remains that this kind of stuff, or Trump-China visit, or US rate hike, a very simple query, and a personalized view that can be exposed. So we see a huge inclination towards here. And because we've always said advisory needs to be scalable and it needs to be personalized, I think what AI will enable is for that. So yes, so we are definitely leaning in out there.
Dhruv, great to have you. Dhruv Arora there, founder and CEO at Syfe, joining us here in Hong Kong. We got plenty more coming up. This is Bloomberg.
Take a look at Kioxia with its AGM underway today. We are seeing the stock running high, following on from Micron, but also we're since hearing how it plans to list US ADRs in April or May next year. So these memory makers are looking to raise capital in the US. We're also hearing how it's considering that stock split. We'll continue tracking these memory makers. This is Bloomberg. Right, it's 11:29 a.m. in Tokyo, and Japanese markets are going to break in a minute. It looks like a pretty dreary day in the Japanese capital. But if you look at the stock performance, it's really going against the grain there, right? Following on from those Micron earnings, AI investors are in a really optimistic mood. You are seeing the memory players, not just a Micron or SK or Samsung. Kioxia is also running higher today. That's helping to lift the Nikkei. We are seeing among the other tech stocks that are gaining ground include Tokyo Electron and Disco as well. All this coming at a time where dollar yen is inching ever closer to the 162 handle. Okay, taking a bit of a breather for the moment, but this is all, of course, coming against the backdrop of that resurgence in the greenback. Yvonne?
Yeah, I mean, this Kioxia plan, it could be interesting, right? So they're planning to list its ADRs in the U.S. around April or May of 2027. So this is kind of following what we've been hearing from many chip makers, right? SK Hynix was the one that really made that announcement earlier here. So certainly you're seeing more of this pattern of maybe looking at ADRs as a way to capitalize and really fundraise. So certainly that is probably what's lifting Kioxia as well. And more news when it comes to the chip sector here, maybe more of the legroom here when it comes to this AI trade, right? There you go, 8% gains for Kioxia here right now. We're watching the rest of Asia. That's really kind of helping overall the benchmark here. MXAP is up more than 1. U.S. futures are punching substantially higher here. We're up about 0.5%. Of course, obviously we saw with Micron, in the after hours surging some 15%. It could do pretty well on Wall Street when things open up. And the Bloomberg Dollar Index is also cooling down a bit. So this sort of big move that we're seeing when it comes to, of course, the greenback, that certainly takes a bit of a pause, and that's really helping risk assets here today. Energy certainly is the one thing to watch here, given that we have seen oil prices now back sub 70 and really erasing all the gains that we've seen when it comes to Brent since this war began. That certainly is also helping risk this morning. There is one thing to watch, though, is Alibaba, which continues to deal with a lot of geopolitical sort of headwinds of late. Well, what we learned recently is Bloomberg is reporting that Anthropic is now accusing Alibaba of using thousands of fake accounts to illicitly access its cloud AI model. The U.S. company says rivals, including Alibaba, may be trying to build chatbots cheaply through a technique known as adversarial distillation. All right, joining us now to unpack all that is our Bloomberg Intelligence senior analyst, Robert Lee. Tell us a little bit more about these allegations.
Okay, well, first of all, this is not the first time Anthropic has made such allegations. I think 6 months ago or so, it came out with a similar statement accusing Moonshot AI and Minimax, which are two AI startups in China, of a similar distillation attack. So again, for those of you who are less familiar with what distillation is, I think the best analogy is to consider something like a master of a trade, somebody who has built up their skills over 30, 40 years. They know everything there is. They've got real mastery. Whereas if they took on an apprentice, their apprentice doesn't have 40 years to learn that trade. The master just needs to pass on the essential knowledge to put that apprentice to useful work, whatever it may be. That's the best analogy to consider this. So the allegation is that Alibaba and previously other Chinese firms have been illegally accessing Anthropic's models, basically pulling data from them in order to speed up and accelerate the training on theirs, which ultimately, if that were proved to be correct, would save the Chinese firms a lot of money and allow them basically to cut corners. So that's the allegation. Yeah. I don't think there's been a response from Alibaba, I should say, at this point.
Right.
I would imagine they're probably going to refute these claims.
You think this could ultimately lead to a full U.S. ban on Chinese models? Why?
I think that's the risk. You just got to look at the direction of travel. I mean, was it a couple of weeks ago we had the White House putting a ban on foreign countries accessing Anthropic's most advanced models? I think, again, although they didn't explain explicitly, it also ties into this concern about distillation. And also, we've recently seen a number of Chinese firms added to the DoD list and also the Department of Commerce list. So I'm not suggesting that a ban is imminent, but again, that is the direction we are taking. And I think the US administration appears to be taking a more robust approach to this. So I think if companies were to be banned, again, it's those with more direct allegations against them. Again, the likes of the smaller companies, whether that would include Alibaba or not remains to be seen.
Yeah. Talk to us about that, Rob. I mean, if we do see a full ban, which Chinese firms would be most exposed?
Simply put, I think it's the ones who are more clearly targeting overseas markets. So first of all, who's less likely to be impacted? The likes of Tencent and even ByteDance. Their AI strategy is mainly focused on the domestic market. Therefore, I think they would be less exposed if we do see foreign bans. Whereas I think Alibaba's CEO said even this week, to paraphrase him, we're going all in. We've got full stack solution. We're going down the chip route. We're going down the model route. Tokenization, selling tokens. They've even got a business called Token Hub. So that is clearly what they're targeting, and therefore that brings a greater level of risk. I'd also say as well, given the sort of effective penetration pricing on these models at the moment, tokens by and large within China, whether that is within the domestic market or externally, are sold at a loss. Therefore, if you look at companies like Minimax and Jupu AI, which is making the headlines recently, rising agentic AI use and therefore rising token consumption will actually widen their operating losses. And we saw with Jupu, I think yesterday, there were unconfirmed reports that it is planning to come to the market and raise money. And this comes, 5 months or 6 months after the IPO.
Yeah.
So, Jupu is going to burn through, and I use that phrase, deliberately, they're going to burn through close to $700 million in cash. That's quite something for a firm with around 600 developers.
Right, Rob, thank you for talking us through these risks there for these firms. Bloomberg Intelligence Senior Analyst Robert Lee. Here are some of the other corporate stories we're following. OpenAI has unveiled its first custom AI chip developed in partnership with Broadcom. It's part of a bid by OpenAI to gain an edge by tailoring hardware to better run its AI products. Broadcom says the chip, called Jalapeno, is in testing and showing cost savings of roughly 50% compared with typical AI graphics processing units. Bloomberg has learned that Google is set to lose 2 more leading AI researchers to rival Anthropic. Sources tell us Jonas Adler and Alexander Pritzel were viewed internally as key contributors to Gemini. They're the latest in a series of high-profile departures that risk undercutting Google's position in the AI race, Yvonne.
Well, Chinese solar manufacturer Jinko says it expects to break even this year as government measures ease the chronic overcapacity that has plagued the sector. Global Vice President Danny Chan told us exclusively where they're seeing opportunities and the impact of the U.S.-led war on Iran.
This year is a pivotal year for recover the break-even. And I'm so optimistic through the year that the profit will recover to the normal level. Yeah.
So do you think the break-even can be achieved this year?
Yes.
What is your most important market for growth right now?
Middle East, Asia, Southeast Asia particularly, and the U.S. because of the explosive growth of data centers, and also the European.
Is the Middle East business being impacted by the Iran war?
Yes, sure.
How big of an impact?
I think it counts for 25 of our whole business. Yeah, they are so ambitious. You know, the region, especially Saudi Arabia and the UAE, lay out a very ambitious plan and targets to shifting from their oil export to their computing power and green power export.
I'm curious about the US because recently you have divested your stake in your US factory and reduced your stake to 25%. I suppose it's to comply with regulations, but does it mean you are reducing your priority to expand in the US?
Of course not. Yeah, we will. This actually is just you know, as we said, comply with restrictions, and we will continue to further strengthen our footprint in US because this market, first, it's a premier price market and it has robust and a long-term sustained demand for renewable, especially driven by their data center explosion. So it's very important for us, not only the PV sector, but also the ESS business.
But given the regulations to qualify for these tax credits, does it mean that you have to change the way you do business in the US?
Yes, more flexible and more diversified cooperation models, but a joint partner, joint investor, or other things.
Let's talk about energy storage because that has become a new emerging growth driver for many solar companies. What is your company's business outlay in the ESS space?
The sales target for ESS business this year is set up 10 gigawatt hour to 12 gigawatt hour, more than doubling that of 2025. And in the next 3 or 5 years, yes, maybe so PV will still be the dominates the revenue and the profit contributor, but the BESS sectors is growing so faster with annual growth rate is about 100 to 150 for Jinko Solar. So it will catch up.
What's your capex spending?
Yeah, it's a secret.
That's a secret.
It's a secret. Don't worry about fund. Don't worry about capital. So much capital waiting for entering sector.
Right.
So technology is most important. And the manufacturing excellence to make it a real product is much more important. Otherwise, technology is stay in lab.
Jinko Solar Global Vice President Danny Chan there speaking exclusively with Min Lo. Coming up, China's luxury shoppers are going top tier with fewer intending to buy, but those who do, set to spend more when it comes to some of these ultra premium brands. Bloomberg Intelligence's Catherine Lim joins us next for more on what they got, what they learned about this latest spending survey. This is The China Show. Yeah, we've been talking about this two-track economy, right? When you talk about consumption malaise versus booming exports, and really the divergence that we're seeing across this economy certainly is one thing that we continue to track here. What does it mean for the luxury sector in China, right? Because when you take a look at how the ultra wealthy are spending, yes, there has been this rising trend where consumers are becoming much more selective. Bloomberg Intelligence has a great survey that came out here where they it really looked into not just category by category, but also brand by brand. And what they found was that when it came to timepieces, handbags like Chanel, those seem to be more of the favorites then when you take a look at some of the broader sort of discretionary outlays out there. So certainly a very interesting piece. We're going to all break it down to you, Avril. But yes, let's just talk a little bit more about just how selective they really are and how are they defying this slump that we're seeing in consumption.
Yeah, super interesting trends that our BI team have uncovered, right? Let's get more with BI senior consumer analyst Catherine Lim. So, Kat, talk to us about what you're seeing in the luxury market. I mean, these shifts, whether it's jewelry, whether it's bags.
Yeah, I'm glad we're having this conversation because we're going into the summer holiday and we're going to actually hopefully see some of that spending coming through within China. But I think, what is really interesting is that if you actually look at the respondents who have actually shown an inclination to want to buy, whether it's jewelry, watches, bags, or even, premium sportswear clothing out there, more than 80% plans to actually spend more than they did previously. So, there is definitely some indications of actually trading up for a huge number of these brands itself. And I'm really interested to actually see, in the next quarter when we run this survey again, whether we're going to see some signs of that.
You talk about brands. Yvonne mentioned Chanel. Is that the one that stands out to you? I mean, right. Which are the luxury makers that are really benefiting?
Right. Again, we're talking about the big 3 or 4 categories, whether it's jewelry, bags out there, and just focusing on these 2. For instance, jewelry, the Bulgaris, LVMH Bulgaris, Cartiers, and Van Cleef, they're neck to neck, across the sector. But that said, again, I think, there's so much to digest with our surveys because we've actually cut through Beijing, Shanghai, Guangzhou, and Shenzhen as the mega cities. And some of those trends actually differ from the emerging tier 1 cities like Chengdu, Hangzhou, for instance itself. But again, the top 3 jewelry brands, the Bulgari, the Cartiers, and then the Van Cleef. Bags is, of course, we've actually got very interestingly some of what I think is actually quite representative of, the younger populations, Chanel, Dior, and Hermes.
Yeah, I was just going to ask you that on the demographics. What are you seeing among millennials and what they aspire towards when it comes to luxury buying?
Yeah, you know what? Across the 3-4 sectors itself, the millennials actually show the strongest inclination to actually buy over the next 12 months. Whether, again, it's watches, jewelry, or even bags. What I would just like to highlight, just to complete the discussion, even for gold jewelry, as we actually, conducted the survey when gold prices was actually going down, we've actually seen some inclination of them wanting to actually buy more when gold prices dip. So, again, I'm really interested to actually see whether that comes true over the next couple of months.
Yeah, Catherine, do you think that some of these trends are sustainable? I mean, what do you think is driving? I mean, people are talking about, emerging Chinese brands, but it seems like a lot of these foreign brands are still dominating the luxury sector right now.
Right, Yvonne, I hear you. And we have 2 segments, the jewelry as well as the bags, where we actually dive into the domestic brands. So whether it's the Chow Tai Fook, the Lao Pu on the jewelry side, and even on the bag side, I'm sure some of you would have actually, also heard about Songmot, Grotto.
Yes.
These are, I would say, your premium luxury or, affordable luxury. Some calls it that. We actually even had indications from respondents that, they are aware of these brands and they would buy them as much as they will do with international brands as long as the design is right.
Yeah, all right. Support local, right, in a way, I guess. Catherine, great to have you talk through these pieces and analysis that have come out. Catherine Lim, our senior consumer and tech analyst of Bloomberg Intelligence. Subscribers can read the full report on the Bloomberg terminal now as well. We'll continue tracking, on top of the luxury trends that we're seeing, markets in the region as well. This is Bloomberg.
Well, Canada's defense minister says he's planning to send warships to the Indo-Pacific in 2 deployments this year, a bid to deepen military ties with regional allies, even as it seeks closer trade relations with China. David McGuinty spoke exclusively to us as he visits Tokyo, and we asked him about President Trump's push for allies to spend more on their militaries.
Canada has upped its GDP spend on defense to over 2%, achieving the target a full 5 years ahead of schedule. So we're very pleased now to get the resources that we need to make these investments. So we are investing heavily in rebuilding, rearming, rebooting our Canadian armed forces. We also have a new defense industrial strategy where we're investing heavily in Canadian companies, the defense sector, and we need to do that together with good partners like Japan.
The NATO Secretary General trying to appeal to President Trump's side when it came to boosting their spending. It doesn't necessarily seem to have worked. How is your relationship with the United States, especially military-to-military security concerns?
Listen, we have a continental security arrangement with the United States. We manage the relationship. We have NORAD, of course, which is the only binational command in the world. It works well. It's together. But, you know, this is about now for Canada expanding in this area here into the Indo-Pacific. I've had meetings and arrangements with folks in Indonesia. The Philippine Minister of Defense was in Canada 2 weeks ago for the first time. Korea, Japan, of course. Australia just sold their over-the-horizon radar system to Canada, the largest single defense export in Australian history. So Canada is moving coherently, systematically into the region.
I mean, you are sending your warships to the Indo-Pacific for port calls to Japan, training as well, exercises. Is there a concern that that might be seen negatively by China?
It's not new. We're recalibrating our relationship with China, but we're also, as I say, we can do both at the same time. We can recalibrate. But on defense, security, and intelligence, we're also reaching out to like-minded, values-driven, rules-based countries like Japan. And so far it is taking hold. People are very receptive, welcoming Canada. But the presence of vessels in this area is not new for Canada.
When it comes to these exercises and training in the region, we always see them very regularly. But very regularly, we also get negative reactions coming from the likes of Beijing. We have seen tensions increase in the Taiwan Strait. Now with geopolitical flashpoints like Ukraine, does that give Canada also a different sense of responsibility when it comes to different regions?
Well, it would be fair to say that things have changed. Tensions have changed. The geopolitical has changed. Canadians are realizing now that their geography won't necessarily protect them. We saw, for example, in the Middle East, Iran deploy a missile that actually traveled 5,000 kilometers, when we've been told for over 2 decades they had no such missile in their arsenal. So we understand that change. We understand the threat landscape has changed. But we're managing our way forward cautiously, thoughtfully. We're building these relationships. We're moving into the Indo-Pacific in a way we planned on doing so in 2017, 2018, the pandemic hit. And now that we have more resourcing as a result of the 2% fund, and we're well on the way to the 3.5% fund, we are in a position now to do much more.
And that was a Canadian Defense Minister, David McGuinty, speaking exclusively in Tokyo with Sherry. All right, here are some of the global stories that we're tracking for you today. Venezuela has been hit by 2 of the biggest earthquakes in its history, toppling buildings in Caracas and knocking down power lines and damaging the capital's main airport. A magnitude 7.2 quake was followed less than a minute later by an even larger tremor measuring 7.5. Terrified families remained in the streets as the capital was hit by aftershocks. U.S. Secretary of State Marco Rubio has met the leaders of the UAE and Kuwait as he looks to reassure Gulf allies over the interim peace agreement with Iran. It comes after Iran and Oman said they were looking on an agreement over the Strait of Hormuz. Speaking in Kuwait City, Rubio sought to ease concerns over the prospect of tolling in the strategic waterway.
When we mean open the straits, we mean open the straits free in international waterways. I know of no country on the planet that supports tolling or a fee for the use of the straits. That's not going to happen. The president has been abundantly clear.
Japanese Prime Minister Sanae Takaichi has unveiled a long-term economic plan featuring massive spending in AI and chips, along with other key sectors including defense, space, and shipbuilding. It calls for more than $2.3 trillion of investment in the fiscal years through 2041. Economists say the plan is unprecedented in scale and scope, while also lacking details. All right, we're checking markets here this morning, and oil certainly is going to be a front and facing theme here. We continue to see the cooling when it comes to Shanghai futures. We do see the likes of WTI sub 70 at one point there. Brent also erasing all of the gains that we've seen since this Iran war began. So there you go. We continue to watch some of the oil plays heading lower today. We're also watching when it comes to, these are some of the big moves that we're seeing across Hong Kong here. 8% drop for Trip. Those earnings came out, did miss estimates as well. Sunny Optical also lower by 8%. That's it for us here on The China Show.